Are you raising capital right now and struggling with the choice between giving equity away or issuing convertible debt? Because I'm about to walk you through how top-tier founders and private equity-backed CEOs quietly make this decision and how it impacts your exit multiple later. This is not a textbook explanation, this is from real M&A deal experience. I'm Imad Ilyas, Head of Operations at Churchill Mergers. We advise founders and investors through strategic mergers, acquisitions, and capital structuring decisions. And today, I'm going to break down the real strategic trade-off between equity versus convertible debt, not in theory, but in terms of control, valuation, positioning, and future exit leverage. The big decision isn't about today, it's about exit power. Most founders ask, which is cheaper, equity or convertible note? That's the wrong question. The real question is, which option gives me stronger leverage during a future acquisition or valuation event? Because investor terms today can directly lower or multiply your exit price. So let's break down both in business reality, not theory. So let's start with equity. When does it actually make sense to give it away? You give equity when you want strategic partners, not just cash. The investor brings market access, acquisition pipeline, global distribution, regulatory clearance, something your competitors don't have. You need long-term active alignment, not a passive check. Equity is expensive, but expensive is not always bad if that equity pushes you into a higher acquisition bracket later. We have seen founders give 10% but unlock 8 times larger exit offers because they brought in the right strategic equity partner early. Now, the flip side, convertible debt. This is where founders often get things very wrong or very right. Convertible debt is brilliant when you know your valuation is about to jump, but you don't want to lock in a low valuation today. It's essentially saying, give me the money now, define my value later. Founders use it when they're weeks or months away from major product launch, profitability milestone, strategic acquisition interest, active M&A market timing. It lets you raise capital without losing equity today, while deferring valuation to a future higher round. That's why most M&A-aware founders prefer this instrument before a sale or valuation event. Let me tell you where most founders get trapped, and they don't see it coming. But if you structure the wrong convertible note, especially with no valuation cap or discount, you accidentally give away more equity later than if you had just done equity upfront. This is where most deals go wrong, not in the instrument, but in the terms. Conventional startup lawyers miss this. M&A advisors do not. Here is the exact decision filter we use internally with our clients. Here is the framework we use with founders and PE-backed CEOs. If the investor is giving capital plus strategic offensive power, equity is justified. If you're on the verge of a higher valuation or acquisition event, convertible debt is the smarter move. It's not cheap versus expensive, it's control your exit versus sacrifice your exit terms. If you're serious about raising capital or preparing for an exit in the next 12 to 24 months and you want the structure of your deal to actually increase your exit multiple and not just get you funded, then speak with our team at Churchill Mergers. We don't do generalized advisory, we engineer investor-ready, acquisition-ready deal structures for founders who are playing for a premium outcome. If that's you, this is the moment to start the conversation. Reach out to us at churchillmergers.com. The link is in the description.